My name is Ned Harvey. I'm a managing director at Rocky Mountain Institute, and I'll be moderating the next session. I'm excited today to introduce to you, or hopefully let you all know more about a concept that has been a long time in the making called True Solar. In a second, I'll introduce the panelists, but I'd like to give a little history. Some of you may have heard of it, but about 4 years ago, Rocky Mountain Institute convened an event in San Jose, which we called the Balance of Systems charrette. The entire industry was focused on reducing costs, but reducing costs at the module level. And we had a hypothesis that was going to take care of itself, but that the real issue was on balance of systems. So we convened about 100 people from all over industry to look at 3 different things. 2 were the focus. One was racking and installation, and the other was electrical. And there was this tiny little work stream called process, which we didn't know much about, nobody knew much about. Coming out of that, we had a revelation. Hardware, modules, and electrical components were going to take care of themselves because the industry knew how to drive scale. But the process side of putting solar out was the biggest barrier of all. And at that time, nobody was talking about process. Importantly, within the process, there was permitting, inspection and interconnect, there was customer acquisition, and then there was this deal flow question. And nobody really had their hands around those, but between Jen DeCicero and Doug Payne and Rocky Mountain Institute, we decided to go out and tackle that, and Sunshot was born. And out of Sunshot, we've driven tremendous improvements and progress on permitting, inspection, and interconnect, and we're working hard on customer acquisition, but this deal problem, especially for commercial industrial, remains one of the biggest challenges. And back then we envisioned actually trying to create a standardized tool set that would bring standards to the industry that would reduce the cost of getting capital, that would reduce deal dropout, that would increase liquidity in the market, and would pave the roadmap for securitization. We didn't know what it would be or what it would look like, but what you're about to hear about is the end result of 4 years of effort, led by industry, but with participation from a broad range of participants. So I'm going to introduce the panel, and I'll give them each a chance to talk about their organization and why they're involved in True Solar. I'll start with our fearless leader, Chase Weir. Chase, tell us who you are and tell us a little bit about True Solar.
Thank you, Ned. Before I introduce myself, I want to say this is the most people I've seen in a conference before the conference of any event I've been at, and I want to thank our hosts at Green Tech Media and maybe give them a quick round of applause for bringing us all together. So we're proud to be among the key proponents and promoters of the True Solar Initiative. For us, the genesis of it probably pivots around 3 key lessons or discoveries. One, we went from, in our first 2 years of operations at Distributed Sun, of looking at maybe a couple $100 million of deal flow to, in our 3rd year, looking at almost $3 billion of deal flow. And it became painfully apparent that we couldn't do that the old-fashioned way, rolling up our sleeves. We had to bring in information management, automation. We had to think about uniform practices and operational efficiencies. A second discovery was, and it was really interesting because we talked so much about soft costs and other soft costs, direct and indirect. What we weren't talking too much about were the hidden costs. And when we realized that every deal that we successfully did, we were paying for all the deals that we did not do, the ones that dropped out. We were also paying for all those deals every counterparty to our deal didn't successfully do. And we wanted to address that. And as we thought about it, we realized this thing now called True Solar was really the only way to get at it. And I guess the last idea, and feeds off the second, is that it was too big a notion for us to do by ourselves. In fact, in 2011, we kind of announced to the industry that we were doing better practice internally, and it didn't take us long to realize nobody really cared. The benefits of something like True Solar are premised around every counterparty to our deals using that same practice. and the counterparties and deals that we're not involved in using the same practice. So, those are 3 key points that drove our promotion of True Solar.
Great. Next, when we started to try to create this risk screening methodology, there was a bunch of us at the table. We all kind of knew our bits and pieces of the risk profile, but we needed a partner that could help us put it all together and build credibility around the methodology itself. So I'd like to introduce Brian Carey, U.S. Clean Tech lead at PricewaterhouseCoopers, has really led the effort in creating the standard and the methodology. So Brian?
Thanks, Ted. Hi, everybody. And sorry, my voice is a little scratchy. I'm still recovering from a cold. But as Ned said, I'm Brian Carey. I lead the Clean Tech Advisory practice at PwC. We do a lot of work in strategy, deals, and operations, really across the broader kind of solar value chain ecosystem. We originally got involved with this because we've got a group of folks that are really passionate about solar and its long-term potential, and we see it impacting, not just the energy sector or the utility sector or the technology sector, but really all the different industry sectors that PwC serves today. But more specifically, as it relates to our role for True Solar, the group, the initiative needed an independent third-party group to really facilitate a broad variety of interests and skill sets and companies with different objectives to bring a third, non-biased perspective. And our main activity is really to be work with the working group, develop our RSCM, risk scoring criteria methodology tool. And in recent months, we've been using that tool to test and validate it against a set of beta projects to help validate that it does what it expects to do and is going to be ready to hand over to a longer-term entity down the road.
Thanks, Brian. We also needed a partner that had experience in certifying and understanding risk pools. So we invited Underwriters Laboratory. So I'd like to introduce Evelyn Butler, Global Director of Business Development for the Energy and Industrial Systems at Underwriters Laboratory. Sorry, I'm getting a little feedback, so I'm kind of getting ahead of myself, behind myself. Evelyn?
Yeah, no problem. Thanks, Ned. So as Ned mentioned, and many of you might know, at UL or Underwriters Laboratories, we very much like standards. And so the opportunity to work with industry, and particularly solar, because we're very committed to helping the industry mature and really reach points of adoption that I think we have yet to really think about what's possible. But the opportunity to help bring some of the mechanisms and the models that we have been able to create internationally from a product perspective was very important to us, because we thought, here's how we level the playing field, but at the same time enable innovation. The second piece that very much appealed to us for True Solar is the equipment side. And I think we heard a lot earlier in some of the previous discussions about inverter service lifetime, panel degradation. How do we look at those scientifically and fit them into that equation so that they're not unknowns? So how do we use testing or plant inspection or other services, and how do we help compare those from one project to another so that we can reduce some of those variables? So that's really the 2 key things that appealed to us about True Solar, and I think that you'll find, as all of us speak today, there's a lot of things that would appeal to a lot of you as well.
Thanks, Evelyn. And lastly, when we started looking at this, I was shocked to find out that there was no bill of materials in the solar industry. That when you were going to go spend a couple $100 million on a lot of solar, that you didn't know exactly what you were going to get in that without a whole lot of due diligence and a whole lot of digging around. I don't think that's how the coal industry works. I don't think that's how the energy industry works at all. And so we knew that if you were going to try to build a product and an industry that can compete head-to-head with the entrenched industries, we had to be better about system componentry, and understanding exactly what you were going to get when you put together a project. So we invited DuPont to join us. I'd like to introduce Conrad Burke, Global Marketing Director of DuPont Photovoltaic Solutions, to tell us a little bit about what they did for True Solar.
Thank you, Ned, and again, also, we're delighted to be here today. Just to follow from what Evelyn was saying, what appealed to us also in terms of being part of True Solar, when Chase came along a couple of years ago and told us about this initiative, we jumped right on it. We had already been somewhat alarmed with some of the things that have been happening, particularly over the last, I say exclusively, probably over the last 5 years in particular, where, if you recall, and we certainly aren't out of the woods yet in terms of module manufacturing companies and some of the bankable issues, but more importantly, in this race for survival, a lot of corners we saw were being cut in terms of how modules were being manufactured, and solar cells, for that matter, were being manufactured. So we were already, even before True Solar came along, we had embarked upon a fairly big data collection program globally in terms of installed product in the field, and looked at failure rates in solar panels. And we did that independently on our own and started looking at the problems that were starting to surface, which somewhat concerned us. We've been looking at solar, we've been in solar ourselves for over 30 years. We have, as a company, about 5 trillion, I should say, panel hours of experience in terms of materials. We're the largest supplier in the world of materials into the solar panel industry. But we were somewhat alarmed in the last 5 years seeing high failure rates in products that haven't been seen in the previous 25 or even longer years. And it was as a result of using pretty inferior, unknown materials, and just the quality and workmanship associated with products was really deviating. So we jumped on the opportunity to at least give our input and raise the awareness. And the very fact that we're even talking about it here today, I think it wouldn't even been a topic a couple of years ago, I think it's a success in itself. So an awareness level, raising that to the discussion and getting people to think about what you're buying and what your long-term investment is going to be if you're buying something that's going to fail or not going to perform the way it should be in a couple of years. So that's where we come, and I think we've been adding a lot of value. I know we have, in terms of data, understanding of materials and how they interact in systems that are supposed to be on a rooftop or on a building for 25, 30 years, and how they perform. So we're delighted to be part of it. I think we've raised, as an industry, this discussion, and we're not out of the woods. I think we have a long way to go yet, but I think we're certainly making good progress as an industry.
Thanks, Conrad. So I think when we were in that room back in 2010, somebody was saying we need a FICO score for commercial industrial projects. And essentially what True Solar is, it's that FICO surrogate. What we've tried to build is a tool to standardize risk evaluation, a methodology and criteria for understanding the pools of risk that exist in commercial industrial solar deals, and to understand how to quantify those risks in a way that then can be turned around to both buyers and sellers to help make the deal go faster, make capital flow faster, and ultimately speed adoption of solar and take the price out of solar. So I've got a couple questions for the panel that I'm sure are on many of your heads. I'll ask a couple of them, and then we'll turn to the audience for your questions. First, Evelyn, I'll lead this to you. Starting up a standards body is not a small undertaking. Why do you think this is going to be successful?
I think there's a couple of reasons. Number one, I think this is probably actually one of the first types of standards bodies that's been created as an impetus from industry. Usually, standards bodies come from an administrative perspective, either a regulatory mandate or a country import law that's been enacted, and we need to figure out a way to actually administrate it. So I think that in solar, there's a pretty darn good record that collaboration works. And I think for this particular group, the number of companies that are represented and the number of companies and the types of companies we'd also like to bring into the effort would speak a lot about the fact that we're not going to let the effort fail. Secondly, I think what's very interesting is of the companies that are partners today in the True Solar effort, there's over $1.5 million that's been committed in terms of outlay as well as time, effort, and contribution. And that's going forward. That doesn't even include the kind of commitment we've all made over the last couple of years in our time and effort to help pull the tool together. So I think from the perspective of commitment, I think we definitely have that. I think as an industry, we're able to pull that off better than I think any other industries are able to do. And I think you also have the commitment in very tangible ways from each of the partners.
Anybody else have a thought on that? All right, Chase, I'll give one to you. So the original beta test of True Solar has been on 14 projects. Is that enough?
I think it's important to explain what 14 beta projects means. It's not, in research parlance, a statistically valid sample for testing. It's 14 distinctly unique project types that allow us to test the depth and the breadth of the framework to make sure that when we hand that screen over to an accreditation body, that then it's ready to go through further research and development. We've looked at, in our distributed solar network, probably over 700 projects over the past year and a half. So as a key participant in the initiative, I'm sure that over the next 18 months, we'll run at least 1,000 projects just at Distributed Sun through True Solar. But it's also important to note that we have, I guess, 6 early kind of test users in 3 different groups. Those that have new finance platforms that are coming into the marketplace that are looking at a lot of deal volume and interested in screening their deal flow with True Solar. We have developers who have a lot of deal volume that are interested in pre-screening their projects before they submit them to finance. And we have 2 leading institutional financiers who are ready to run True Solar in parallel to their existing processes. When you add all those up together, that's probably an annualized run rate of another 1,000 projects. So if in 2014, the estimates are some 9,000 to 10,000 unique commercial projects will be placed in service, that's pretty significant market share quorum before we even release the screen.
Thanks. Anybody else? Conrad, you talked a little bit about some of the concerns DuPont's had with panel quality and panel failures. How will True Solar help the capital markets assess that risk?
Well, probably a couple of ways, but I think at the main level, just the vehicle to communicate. We are as far upstream in the supply chain of solar panels as you could possibly get. We make products that are shipped in jars or in rolls, so we're not typically something that you would think about from the final product when you look at a solar panel, if you may. So, if anything, the True Solar platform, I mean, the very fact that I'm sitting up here today is an example. We have a vehicle to communicate, and we don't have, being so far upstream, we don't have the luxury or the capacity, if you may, to reach out to financiers, insurance companies, underwriters of these types of projects, which quite frankly are the ones that have traditionally been the least informed about what's inside their product. And to your earlier comment about bill of materials, it is something that's been overlooked. I mean, I used the term bankability a few moments ago, and bankability, in what I learned in most people's minds, was the balance sheet perspective of a module manufacturing company. And I think we've raised the education level now through True Solar and many other vehicles, I should say, too, in terms of communicating that it's also important in terms of what's the quality process and the procedures used to make products, and have we deviated from those. And the true answer is we have, and we're getting back to the norms, I think, or hopefully on that trajectory. So certainly the communication has been a big piece. But also we are part of a working group. In fact, there was a session this morning where we were involved, where we bring an insight from what we know in terms of I mean, we've calculated of the 400 million solar panels that have been installed around the world since 1975, half of them have DuPont in there. We've got, as I said earlier, the 5 trillion panel hours of experience. So we also collect and buy up products that have been installed for even as far back as 30 years ago and look at how they've been performing. and doing analysis on those, and I know UL's done a lot of work on that regard too. So we bring a data perspective. We like to think of ourselves actually as the big data, or Google of solar, if you may, in terms of understanding how these things perform. Because there aren't very good models to predict failures or problems with these types of products. The physics is quite complicated. So the best data you have is actually just to go out and use historically what's out there and take a look at that and use that as your basis. And so I think the True Solar has given us a vehicle to communicate. It's also given us an opportunity to communicate within the working group, which is way bigger than what's on this panel here. There's a lot of very smart people from all walks of life and different parts of the supply chain. So it's been, I think, very effective. We're pretty pleased actually how it's going.
Thanks. Curious, in the last month, or actually the last 2 weeks, RMI has gotten calls from China and Canada looking for essentially a True Solar. So Brian, I'm curious, is this a US-only product, or is this something that is applicable in other markets?
No, it's not just a U.S.-only product, and to add a couple more countries, we've actually heard from a number of folks in Europe and India as well. So we are getting a lot of interest globally. I think if you look at the overall framework that's used to evaluate risks for projects, it's applicable globally. It might require some customization for local needs or regulatory requirements, et cetera, but definitely applicable globally. And I think if you look at the working group members, there is interest from them to try to take this to the global level. Most parties up here, the logos that you see up there, have a global footprint, are multinational. So we just don't see this as a U.S. opportunity. It definitely has the ability to be rolled out at a global scale, and you should start to hear more about that in the coming months as we continue to push the effort forward.
Thanks, Brian. So I have one more question, and I'll open it up to a couple questions, and we're going to make a shift in the panel. One of the common refrains I've heard from various different people in the industry over the course of putting True Solar together is, it seems like kind of a closed group of people putting this together behind closed doors. Why didn't you do it open? Why don't you make this a sort of open collaborative network? Chase, how do you respond to that?
That is a pretty regular refrain. I think a good comparison is another group that we're involved in, we're members of, proud to be members of, called SAPSI. I think there's some 150 plus companies involved in that group, while there's a dozen or so involved in our group. I think we just took a decision early on that our working group had a lot of hard work to do. And while it was come one, come all, we did ask everybody to play with equal table stakes and put in pretty serious dollars and people resources and sign contracts that were all dedicated to an end goal. And so I think the membership was self-selecting. The good news, though, is the working group alpha and beta phases are almost done. I mean, I would, tell me if I'm wrong, Brian, but it's a matter of weeks until beta is completed. So I think it would be fair to say that as of even today, as we prepare to launch the accreditation body, that we invite everybody in the room, if you have interest in getting involved, to come and see one of the working group members. There's a lot more in the audience. Maybe you can raise your hands. I see Gene with Assurant. We have Panel Claw. We have folks with Booz Allen Hamilton. There's Mike Mendelson raised his hand. This is, let's just say it plainly, this is unique in the industry. We are giving a public good away to the industry upon the backs and the burdens of lots of for-profit companies that have been working tirelessly for the past 2 years to put something together that can grow the overall marketplace for everybody.
Thanks, Chase. I can comment, I wasn't at RMI at the time, but I've heard horror stories. We were at the table when they started the LEED standard way back when, and it took quite a bit longer and I think quite a bit more pain to kind of settle in on a final standard, and this has been remarkably fast. So congratulations. So I'm going to open it up. We'll take a couple questions, and we're going to do a panel shift real quick. Anybody have any? Right there.
Just as a quick question, what do you think the primary, I guess, pressure factors or motivating factors are going to be for the adoption of these standards at the integration level? Because it seems like a lot of integrators have really thrived off of not having to follow specific standards. What makes you think this will be adopted, and how quickly are you going to see that at the integration level?
Brian, you want to lead that one?
Sure. I think if we get support from the financial community and they start to use this as a de facto method of measuring risk, measuring best practices, and there's alignment across the industry on it, you'll start to see integrators moving to adopt those practices so that they're better received in the financing community.
And just let me ask you a question. When you say integrators, do you mean EPCs or project direct? Okay. Yeah, ultimately, what's interesting about this is when you're talking about a risk screen, you're talking about its application during a transaction closing, diligence, at that moment where a development asset wants to become an operating asset. So it's very, very relevant to developers, originators, and financiers, owners. At the same time, if you think about the whole risk stack, everybody in the value chain is going to be scored. So an EPC is going to be scored based upon their experience, upon their balance sheet, whether they can bond. Ultimately, they're going to be evaluated. And as Evelyn will tell you, over time, the risk screen should collapse. So where today I might need to ask 15 questions about the panel manufacturer, in another year, the accreditation body will have pre-scored that panel manufacturer. So then you toggle to the make and the model, making the process much, much more efficient. So I think we're creating an ecosystem for rewards. There will be benefits for being involved.
Yeah, and plus, as we go over time, there may be 10 different ways that one thing's done, right? And if there's alignment on what is a best practice, you'll still start to see convergence on that, right?
And I would also add that a lot of integrators and EPCs, they're pretty well designed in the space they want to compete in. They're typically not trying to be everything to everyone. And so even after a while, if they've got an equipment equation that works for them and they know how that's going to be scored, they know what projects to go after, right? They know who's going to finance them. And so it actually, I don't see it being a situation of resistance, but more, the opportunity for them to show that they've got a pretty solid equation when it comes to what they're bringing forward in a project and who they're presenting it to.
Any other questions? Somebody's got to have a question. Mike Mendelson, you're always good for a question. I'm never afraid to ask.
A lot of the, thanks. Some people might argue that the screening tool could be very qualitative or subjective. So how do you sort of look at different panels and be able to evaluate whether one is better than another or one inverter is better than another? How do you take these different manufacturers' products into consideration, or different ways of doing things into consideration, knowing that, or trying to come up with a risk score against all these different inputs?
Well, if I can just add a comment. I mean, we bring, Chase will add it from answer from a True Solar perspective, but from our perspective, we bring data to the table for True Solar to digest and at least use in some of the discussions in developing these types of specs, if you may call them. But I think it's important to note that the panel, we believe that panels, if you will, have been made quite well, actually, since 1970, whatever, go back to really the advent of the first beginning solar panels in the marketplace. It was really only in the last 5 years or so that kind of went off the rails a little bit in terms of quality, and the discussion in itself became elevated. So if anything, we're not saying that we've had a problem for 35 years, but more a problem for the last 5 years, and just trying to get things back to where they were. And a lot of specs, a lot of good work by people like UL, and even if you go way back to the Jet Propulsion Lab, which you wouldn't think of from a solar perspective, JPL wrote up some of the earliest specifications and bill of materials requirements on solar panels going back, what, 2-3 decades ago, maybe 2.5 decades ago. And they were commissioned by the Department of Energy to do that. And they were the bedrock of how panels were made for decades. And it was only recently we started seeing some deviation from that. So we don't want to give the impression that there's been a problem since day one. It's more recently. But if anything, from our perspective, the data we bring is like, let's get back to the roots of how solar panels were made, if you may. Chase?
Yeah, I'll just add to that you're right. I mean, it is qualitative and subjective on day one. I mean, when we started this process, it was an idea. We lacked a framework. Then we created a framework, and now we are testing that framework across beta projects. And so it's kind of like hitting the side of a barn, I think Costa with Panel Claw would say. And that's the definition of accuracy. We hit the side of the barn. But the precision to hit the bullseye is what we accomplish over time. It's important to note that we're not trying to be a kilowatt-hour analytics or an OSPARC. That notion of fleet data that would inform that comparison. Think about the diligence questions that financiers ask when they think about a panel manufacturer. What is its performance history? What does the balance sheet of the panel manufacturer look like? Is the warranty backed by that manufacturer, and can you rely upon it? So we're talking about the diligence questions and codifying that, and then comparing panels that way. We're not talking about the technical specifications. While they inform the risk and are included in the questions, it's a little bit different than going out and acquiring fleet data. Now, you fast forward a few years, and True Solar has tested thousands of projects, and it becomes something of a cradle-to-grave data point. It's a score on a development asset that becomes an operating asset, that becomes a resold asset. Then it starts to look more like fleet data, but not on day one.
Question right there.
Thanks. I commend you guys on what you're doing. I think it's badly needed in the industry. And I work on the development and the financing side, and as one of my colleagues put it, there's a lot of information asymmetry out there. But I'm just curious, how is it that something like a True Solar never evolved in Europe, which is a more mature market? I mean, I'm assuming that because you mentioned that you received inquiries from Europe.
I've got thoughts on that, but I'll let the panelists take it first.
I think if the feed-in tariff is high enough, it's kind of not needed. But I think also we're probably looking at some O&M issues on a pretty significant portion of fleet. I won't name the U.S.-based financier that deployed a couple hundred megawatt in Europe, but those assets were underperforming 23% relative to what they forecast to investors. So that it did not take root in Europe early, I don't know means that it's not relevant from here going forward. And as Brian mentioned, we have a lot of interest from players in Europe.
It is an issue in Europe. I just came back. I was in Brussels and I'm on the board of EPIA, which is the European Photovoltaics Industry Association, and it is an issue. And maybe it's not as vocal, or maybe it's not as visible like what you're seeing here today, but it's certainly on the minds, certainly at EPIA, and it's certainly on the minds of the installers and developers in Europe, and increasing, if you will. So I wouldn't be surprised you'll hear more on that pretty soon.
Thanks. One more question.
You mentioned the benefit on deal velocity to developers and the ability to screen out bad projects quickly and focus on projects that would get financing and lower their overhead that way. Do you see the same benefit applying to the component suppliers? Meaning they don't have to look at as many bad projects from developers before they actually get an order.
So I'll try to take a stab at that one. I would say from an equipment perspective, absolutely. Again, it's being able to hone in on what your most successful supply opportunity is going to be. And so if you have a way to show that you've been pre-screened or have had a little bit more due diligence done on your product and its performance and how it could help influence maybe a better score for a project, you might have a buying preference there. especially if you've got an EPC or an integrator who's also well informed about how True Solar works and how we look at projects from one side of the country to another, you might be able to create a pretty good preferred channel for your product by doing it that way. Absolutely.
Yeah, I would agree. I think it would help you evaluate which projects you want to bid on and who you want to partner with when you're proposing on something. Definitely, you can be more effective from a business development and sales standpoint.
Yeah, I'm gonna hold the questions for now. We're gonna have another question and answer period at the end, and you're welcome to ask questions of these panelists. They'll be going back down to the audience, but they're gonna stick around and can answer questions. So let's do a quick shift. I'd like to ask to come up to the stage, Tarek Bolta, and Patrick Fox. Tarek is with the Renewable Energy Trust Company, or Trust Capital, and Patrick was with Hannafin Armstrong. One thought as you make this transition, and it came out this morning, I believe, and RMI believes the solar industry is a tipping point. To date, it's still a pretty tiny percent of capacity in the United States, and in fact, it may not even be a part of real capacity. Most utilities don't include it in their resource planning. It's just there. It satisfies RPS. They keep spinning reserves up in spite of it, et cetera, et cetera. But that's going to change. You see utilities all over the country looking, and regulators and populations all over the country looking to use solar as a part of the generating mix, demanding it. City of Boulder is going to dump Excel so they can have solar as our primary generating asset, solar and wind. You also hear about the ancillary services that solar is going to play in the near future, whether it's in aggregate or at the grid level. When solar becomes a material part of operating our grid, and the governments and the big companies and whatever demand from it the reliability that it gets from coal and natural gas today, you will have to perform at a true solar standard. One of the initiatives that we're launching at RMI just got voted the winning proposal at BNEF last week, is an effort to work with the Fortune 100. So by 2025, 50% of their power comes from distributed renewables. When 50% of a big company's power comes from distributed renewables need to work. So that change is going to drive the need for a true solar. And the industry has got to respond to that and get out ahead of it. So with that thought, this panel, we want to talk a little bit about the dynamics between buyers and sellers. So I'm going to open it up just with a simple question. I'm sure none of you have ever had to deal with this, but it was a bit hypothetical. I'm just curious, have you ever had a deal just drop out in the middle of the process?
Yes, I have.
You want to elaborate on that and talk about why true solar is something that you would value?
Listen, the deals drop out for good, bad, and no reason. We recently had a project in financial close. We literally were at the 11th hour. We'd gone through investment committee, credit committee approvals. The funds were ready. Most of the documents, the acquisition, the asset sale documents were done. And then our good friends at Standard & Poor's downgraded the credit of the off-taker a day before we were closing. I wouldn't call that a black swan event, but there's not a whole lot you can do about things like that. I think what you can focus on is realizing a lot of the times developers, buyers and sellers kind of talk at and past one another, and you spend a lot of time kind of willfully or hopefully working on a deal, and you get around, you circle back to some questions that if you had better screening science, you may have noted that there was a fatal flaw earlier on. And a lot of times fatal flaws can be fixed, but a lot of times they kill deals. And so I think true solar is about trying to identify the problems at the very outset, kind of the formula. It's all a formula. Kind of running the formulas at the beginning rather than at the end.
Yeah, just to add to that, there seems to be a tendency with sellers sometimes to want to sort of bury the skeletons of a project until sort of the last moment, or hoping that they won't be found. And to your point, Chase, sort of when the deal dies like that, sort of black swan, S&P downgrade accepted, it's often because there are factors that you're going to find ultimately, but you don't find them until you're sort of at the altar with the when the two parties are at the altar. And so I think if true solar or similar sort of mechanisms can be used to sort of just flag all of those big issues early on, and there are always going to be things that you just can't actually get to until you actually do the hard diligence on it. But if you can use that to even weed out 10%, 20%, 30% of deals, you're going to have a lot more sort of utilization of your internal resources and actually have a lot less dead deal costs, which are a big problem in our sector, especially with these deals that tend to be highly financed, highly levered. If we have to assign dead deal costs to deals that we actually end up doing, it impacts the return significantly and impacts our ability to pay for deals ultimately.
At Hannon Armstrong Capital, we typically sit as the lender for these projects. So Tariq and his colleagues at Renewable Energy Trust have, as of late, been extremely successful in acquisitions of projects. So if we come in later in the process where we're going to provide some leverage, either at project level or at back leverage to those projects, it benefits them and it benefits us, especially as a smaller shop who likes to be efficient in deploying our capital. We don't make money on transaction costs, so we like to keep them down too. We like to have good relationships with our borrowers. Having some kind of universal standard set can be extremely beneficial, even as those deals come to the debt side for the levering process.
So I hear this number that somewhere between 50 to 75% of deals in the pipeline never go anywhere from a buyer's perspective. Are those the numbers you guys experience?
Yeah, I think that's right. There are a few dynamics at work there. One is that you have so there's a lot of capital rushing into this market. So it's a very competitive landscape where interest rates are low. You have billions of dollars going after this sector now, and so sellers actually have the power to keep folks out of exclusivity for a longer period of time, or sort of play things to their advantage. So that's just sort of a fact of the market now. The second is that if you're not able to sort of screen things quickly, we've all spent hours and hours and hours on deals and paid lawyers lots of money on deals only to find that it goes away for some reason that we could have learned up front and saved everyone a lot of time and money. And so when I think of sort of screening mechanisms that I would use as we look to be the sponsor in deals, it's things like this that actually can just let's not waste. We're a small team like Hannon. We don't want to waste our time sort of on deals that we can quickly flag and sort of just put to the side. And so 50 to 75%, I think that's probably a pretty good number, actually. I think it's more like, if you think of a real deal funnel and everything that you're actually looking at and spending more than an hour on, it's probably a fair bit higher than that.
And I don't know so much on the percentage, but one of the challenges that we find is these deals touch many hands throughout the process. We typically have the longest term view of the deals and want them to, we care about how they're operating, in this audience, probably far, far in the future than most people ever think. So there's those who start the deal, those who hold the deal from an equity perspective, maybe through construction, another equity holder that holds it through operation, and primarily where we work is debt, where we sit alongside the construction and through the operation. We have that long-term perspective. Having a universal agreed-upon standard will be helpful in matching up what we could see as long-term mitigants versus some of the concerns, maybe the capital concerns that the shorter-term participants have.
So, if you actually think about soft costs today, other soft costs in balance of system, it's now the majority of the total installed cost. So we have this almost this resistance in the middle of the value chain. Right? So the maturity of any industry is about passing value down to the end, which in this instance is the off-taker, is the customer. When you have soft costs that are not coming down at the transaction level, that puts pressure further upstream and on product pricing, and it keeps us from achieving the lowest levelized cost of energy for solar. So I think for off-takers, it should just, as with owners of assets, inspire them with more confidence that industry best practices are being utilized, just like the effort with SAPSI. It's in ways it's a godsend as a buyer of assets to say you need to use this form of PPA. It's not ours. It's a PPA that's been put together by the Department of Energy, by NRail, by a collection of industry participants, and it has a lot more moral authority that way instead of, use our document. And I think True Solar has the same effect.
Great. So I'm just curious, as this plays out, right now I'm sure you guys are constantly doing business with new developers, new people coming in with projects you don't know very well. Do you prefer to work, well, it's kind of a stupid question, I guess, but it seems to me like you want to work with people you've worked with quite a bit. How will True Solar change that dynamic?
Sure, yeah, I can take that. The way that we think about this is how do we scale the business very quickly? How do we put a lot of money out the door in high quality projects? And so one easy way to do that is to not sort of slug it out with a new seller time and time again, but rather when you have a seller that you've worked with before, you know what they care about, they know what you care about. It's easy to actually scale the business very quickly and really sort of pass along those lower transaction costs and the value that they create to the seller and to the end customer. I think if you have something like True Solar, it just sort of it becomes a stand-in for sort of familiarity in some ways. If you're looking for a proxy to be able to tell yourselves and ultimately the capital markets that you are buying quality assets with contracts that are well understood and sort of hard assets that are well understood. It's just an easy way. It's an easy way for folks to understand it. Like anything is, like the FICO score is, like S&P or Moody's is. You have to sort of bundle up a language that, if you're an investor, you can sort of say, oh, okay, I look at this, I can read a short analysis, and I'm kind of generally comfortable with it, especially on a diversified basis.
From the debt side, similar to what Tariq was saying from the equity side there, is that we're looking to deploy capital, and we're looking to do it both growing the amount that we deploy quarter to quarter and also growing what we consider our client base. And so the ability to have regular customers where we can bring down costs, we can do more business, is something that we strive for, we talk about every single week internally at meetings. As an example, on our federal side of the business, we have one client we've done over 100 deals with since 2000, 100 deals, and we've changed the deal docs twice in 100 deals. And if that client wanted to do a deal for $100, we'd loan them $100 because we work well together. We built this relationship, and now on the commercial side, we just financed a couple of portfolios of residential projects, and those went very well in the first quarter. We're looking to work with that client again immediately. Same thing on the second quarter, just bring down costs, get a standardization. If you could do that at a larger scale, an industry-wide scale, the ability for this to grow and for all the people in this room to win is almost immeasurable.
Yeah, I would agree. I mean, anytime we do a transaction with a party who we've done a deal with before, it's a lot more efficient. We already know the documents. We already know one another. We're not talking at and past one another. Nobody's selling anybody. We're just working on getting the deal done. But I don't believe in this market environment that you can really grow by only doing business with those who you've done business with in the past. And I think the point of True Solar is this kind of democratization or distribution of better and best practice, effectively expanding, widening the aperture of people who you haven't done business with before but who come knocking, and you're speaking the same language when they come to you. I want to go back to the other question that you made about deal dropouts. I think it's not very well understood that there's different types of deals get closed in different ways. Folks originate, folks source, they bid. In the marketplace where buyers are bidding on assets that are in play, I see the dropout for any one buyer to be as high as 90%. And it's not that those deals don't eventually get done, but they're not ready, or they don't get done, or they don't match the investment matrix of that particular investor. I see much higher success rates with very well-heeled developers. They originate, and they have a very, very high hit rate.
Okay. So for Tariq and Pat, I'm curious, as you look at the framework for True Solar, what's the piece you're most excited about, or is it the whole thing?
Well, I mean, I think it gets at, really what Chase just said is, from a company standpoint, we're trying to grow both the deals we've done with our existing client base, and we're trying to grow our client base. to be able to have the, the initial conversations where we don't spend the first month trying to get to know each other, to try to have the same type of jargon that we're speaking, the same metrics, et cetera, to have all that right when we walk in the door, so it can be much more efficient. We're not going to finance every deal in the market, but we'd like to finance a heck of a lot more. And the more efficiency we could put towards that, that helps us. I think it helps others as well.
Yeah, I think the main obstacle to C&I really scaling in a major way is the size of the transactions, in a way that utility scale doesn't face and resi, sort of through companies like Solar City, doesn't face. It's sort of in this pocket where the deals are just sort of small for institutional capital to really come in and sort of take over and play there. And so one way that you solve that is by, you can keep the deals small, you can keep small portfolios of these sorts of assets, but you need to be able to sort of quickly and painlessly sort of transfer them from developers to sort of long-term holders. And so that's sort of, to Pat's point, it's that ability to sort of do that and package that all those metrics together in a way that's sort of well understood. That sort of allows us to do that. And frankly, we like it because it provides diversity to our portfolio. So rather than having 5 projects with 4 different off-takers, if we can add that diversity, it actually gives us a lift in returns and reduces our cost of capital that we can then share with developers. And so it's really that sort of full package and the ability to say, all right, it's okay if it's only a, I don't know, $20 million deal, $50 million deal. We can still bring that on, but we just can't spend all that much time on it. And True Solar is sort of a way to sort of bridge that gap.
Chase, I'm curious, do the accountants and the lawyers like this? Seems like it's going to put them out of business.
I don't think so. I mean, I really, so, it's true today that you probably don't need your law firm to create a power purchase agreement from whole cloth. It's just been done. And yet there are plenty of law firms that are very willing to help a young and new developer create a PPA from scratch. It's important to know that whether it's an independent engineer, an accountant, or a lawyer, that transactions can be more efficient. And if your transactions are more efficient, then you're doing more deals, which then lead to more need for more services. Yes, maybe a little bit of fat out of the services, and maybe you don't need both buyer and seller using 2 different attorneys or other counterparty. Think about sponsor equity, tax equity, debt, seller, all with different lawyers doing the same work at the same time. We're talking about unlocking capital to deploy more solar and provide more fees to professional services providers.
So I have one last question, and those of you who know who RMI is, we're a think and do tank based in Boulder, and we're on a mission to drive the U.S. economy off of fossil fuels and onto renewables and efficiency. So getting a lot of solar out there and making that solar provide us the solar and wind and other renewables and efficiency, but that bundle of generation providing us the power and grid services that are currently done by coal and natural gas is critical to our mission. But an industry that's kind of with a competitive advantage is being able to get the deal done, and knowing how to get the deal done doesn't necessarily get us there. So I'm just curious, because I've got to go back and report to the boss, is the industry ready?
Ready for what?
Yeah.
To give up that competitive advantage. If I know how to get the deal done, if I know how to get the PPA signed a little faster, if I know that panel's better than that, it strikes me as kind of what I hold close to my heart and what I compete on.
All right, there's a little bit of an oligarchy, right? So there are very, very well-heeled, big balance sheet companies with deep, deep pockets and low cost of capital that have worked out their processes. They don't put that on tour to other younger, newer entrants or middle market players. But I think the industry is very obviously ready for this. I think there's an inevitability to bringing common practices at the transaction phase. And I think earlier we were talking about NABCEP. If I have somebody who wants to join my team as an engineer and they're not NABCEP certified, I might give them a waiver, but I'll also give them a book and ask them to tell me the date they're taking the test. There is no NABCEP-like accreditation at the transaction level. The industry needs it. I think the industry knows that they need it. And while it might not give comfort to some of the bigger players, I think at the end of the day, it's going to help them as well.
Yeah, so, I mean, I sort of think of the sector as one in which has historically been just sort of a low volume, high margin business where sort of private capital, private equity capital was a very natural fit for monetizing the projects. And the sector is sort of moving now to one which is a lesser margin but much higher volume business. And so you can sort of think of it like a manufacturing process where you have very customized, high margin products, and it's now shifting to sort of more of a line that just sort of runs through. And part of that is the amount of profit created there, the amount of value created there is actually much, much higher than high margin, low volume business. And so even big players, big balance sheet players, I think are incentivized because of the size of the value creation that's on the table to actually really facilitate that sort of transition away from, high deal cost, sort of a high deal cost model where you work really hard and as a developer you make one sale and there you go, that's you've made a 30% margin, into something where those margins may come down a little bit, but you're putting so much products through the system that you end up making more money at the end of the day.
Okay. I'll open it back up for questions. Kristen, you just moved a hand. You got a question? No? You sure?
When is this methodology or software going to be released?
Chase?
Well, I mean, there's two component parts. So there's the standard and then there's the applied business practice. So I believe the schedule for the True Solar beta testing and the launch of the accreditation body is, I guess, through the end of June. And in the second half of the year, it'll be turned over to an industry body. We're in the process of getting kind of a cloud-based software tool that sits atop the standard, ready to go and have test users already. So again, in the second half of the year is when you're going to see the activity.
Yeah, to be clear, the what True Solar is creating is the scoring mechanism and the methodology, and that will be open to the public or open to people who subscribe to it. But it'll be an open standard that improves over time, and then there'll be various mechanisms to use it. You can get your product certified. You can build a tool to automate it, do different things like that. But we wanted to keep the core methodology in the open standard, and then let anybody take that methodology and do what they need to do to go make the market. Is that a fair way of articulating it? Any other questions? Remember, you can feel free to ask Evelyn, Brian, or Conrad anything that relates back to the original panel. I think there was a question back there. Somebody? Oh, he's gone, maybe? Any questions? Oh.
What segment of the value chain do you think stands to benefit the greatest from if you just venture together in terms of off-takers, financiers, developers?
So we recently ran some analysis about transaction costs and developer margins, and came to the conclusions, right or wrong, we're going to have to prove this, but that if all the counterparties to a transaction are using True Solar, that they stand to gain in the near term as much as 7 cents a watt. If you translate that into commercial projects to be placed in service this year, that's about $115 million of costs going down the drain. But if you look at the funnel of projects that people are working on that are trying to go through that process but aren't being placed in service, use a discounting method, that's almost $200 million. So that's gonna happen primarily and first around those folks that are spending the money on the other soft costs, so the folks that are selling the asset and those that are buying the asset. But I think the benefits across the entire value chain. Again, we're creating an ecosystem for reward and for consideration, and I think that'll become more obvious in the coming months.
Yeah, and I would add, the piece I think we don't spend enough time about is that end customer. As I mentioned, this fire proposal we did, which is on the Fortune 100, the three big barriers at the Fortune 100 are, first off, the perceived risk of renewable energy. Second is the way they make their internal financing decisions, don't prioritize internal projects. And the third one is the people who have to do the job have no clue how to do it, and they don't even know where to get started. And when they go to their boss, say, I need to get a lawyer, an accountant, and an engineer, the deal's done. So the concept that we were talking about here was actually the one that they latched on the most, because I believe they can overcome the other two.
So if you look at financing, let's just say solar is an infrastructure project, right? It's nothing more than that, right? So if we look at fossil fuels and hedging our bet, like an MPP program with gas and oil industries going out 5 to 7 years, and financing is cheap, money's cheap right now, right? So if we can get it just above LIBOR or a couple points, why can't the solar industry get it together based upon the rate of return that's relatively the same as, let's say, fossil fuels at $60 a megawatt hour? Now we can produce solar and get 7 and 8 cent PPAs over a 20-25-year term with rated entities. Isn't that the same type of funding? I mean, what's the rate of return you're looking for to make these deals happen? Because it just seems that you're doing it on an energy basis, whether it's a fossil fuel, but you're not doing it for the solar community, which is really the same thing if we're hedging bets over 20 or 25 years.
Pat, you want to lead that one?
Well, I mean, from a debt perspective, I think you hit on one thing. Historically, if you look at, say treasuries, we're at an all-time low. We have been or I'd say in a 30-year low, much below the 30-year average for quite a period of time. And that is above and beyond this industry, which created that. But this industry, like others, is benefiting from that. We see, as financiers, we see beyond the interest rate. We see long-term assets, stable cash flow, a growing industry. So all of these are growth factors. I mean, we're putting out almost $200 million a quarter to finance these projects. We look to continuing to grow that. So, for us, increasing our business it's easier to do probably in a low interest rate environment. For the folks that we finance, it is unquestionably a very good environment to put financing, depending upon what's needed for you short or long term on these projects. And when I say financing, I'm talking about debt financing. That's one piece of probably a 3-part financing puzzle. So.
Yeah, I think the sector is sort of in this phase where what has been for a very long time sort of mispriced assets are now sort of going through a process of being repriced in a way that makes sense. So to your point, these are contracted cash flows with rated off takers. They shouldn't really transact at private equity-like returns, and they sort of no longer are. They're sort of coming down that return curve to a point where I think we and a lot of folks think that these are ultimately going to trade like sort of dividend products, where you put your money in and you clip your coupon. You clip your coupon at the end of every quarter. And so it's just a question of how quickly you can come down that return curve, and it's different for different sort of types of solar assets. But ultimately, yes, you're right. These will be financed just in the same way that sort of more mature infrastructure sectors are, whether it's sort of highways or transmission or anything like that. They should transact at those types of returns.
And I'd say from a capital market standpoint on the debt, utility scale are financing in that manner. I mean, it wasn't more than a couple of years ago that a large project called Desert Topaz, very large, 550 megawatt project. Before that went out to capital markets, there was a lot of concerns about how that was going to be received. Since then, nearly every project that has kind of been right down the fairway for the capital markets for utility scale solar has been oversubscribed. So they are starting, to finance that. And, some of that is just the financing parties and those holding the long-term paper on those projects getting comfortable with it.
Let me add some additional color and context. I mean, if you're talking about traditional infrastructure, there aren't 10,000 natural gas plants being built this year. So, while a big utility scale power project can afford a ratings team at a ratings agency, a $5 million solar project can't. And yet we're talking about bringing bond-like prices to bond-like risk, and we're talking about the public capital markets. So we have to bring efficiencies of processes in order to deliver those smaller bite-sized chunks at volume into that.
I think that's a great point. I mean, we do a lot of what are considered smaller projects, and we pride ourselves on rolling up our sleeves. Even with that, there's a lot of time that we'd like to cut out of the process.
Other questions? All right. Oh, one more.
I'm not sure if this would apply to true solar, but it's kind of a maybe an interesting question. Why is the residual direct measurable financial benefit that, we're going to see by switching to renewables over fossil fuels not being standardized and taken into account to a greater degree in these models from a risk standpoint and from just the direct financial benefit over time?
Are you getting at the environmental attributes of these projects?
Yes, the environmental attributes, but more in a direct, measurable standpoint, financially, avoided costs in the future of dealing with environmental fallout issues.
Avoided costs, not to sound like a lawyer, but in capitalized terms, and from a regulatory standpoint, is outside of where, as a debt provider, we look. On some of the renewable attribute costs that are inherent with the project, but say at financial close, it's hard to put a pencil on what those costs are. We typically see those as equity upside. And I'll say this as a debt provider, there's nothing better than a project that makes a lot of money over a long period of time for the equity, because the equity always wants that project to be operating well. So some of these renewable attribute programs, REX, SREX, ZREX, wherever you may be, those that are hedged out look like long-term stabilized cash flow and can be underwritten too. Those that sponsors for various reasons don't elect to hedge out, we actually, as debt providers, hope those markets are abundant and valuable and very profitable for the equity holders.
There.
I have a question on what you think of the practice that utilities in California. What you think of the practice of utility companies in California that give tax incentives and breaks for people who buy solar, but then charge that back to all the customer base that does not use solar, if that's a fair way to price and talk about the benefits of solar.
I mean, sort of a policy question. I think that if the government has elected the government and the policymakers and they've decided that this is something that reflects sort of the public interest, then absolutely it's a fine way to do it. It's not perfect, I think, but no sort of public subsidy. I think what we've learned in the solar sector is that no public subsidy programs are. So I think I think it rankles a lot because it's a very concrete thing to point to. Price in scenario A versus price in scenario B. But at the end of the day, it's just an expression of sort of I think what the government thinks it should be doing. So.
Yeah, I think that's in Ned's wheelhouse.
It's just the law of the land. I mean, that's how their rate structures are set in California. It's how the rate structures are set in most of the United States. As a natural monopoly, you have the obligation to serve all your citizens in your state, and therefore you have to serve those who can't pay, and typically you move those costs onto those who can. And then over time, for whatever political reason, most recently renewables, they'll move those things around to the point where in California, the rates you pay in California have nothing to do with the cost to generate and deliver that electricity. It's a completely politicized thing. So that's the nature of our U.S., utility regulatory thing. Will that be the case in the future? We hope not. We'd love to move to a more transactive media where all you guys are developing solar, wind, and efficiency projects and bidding into markets, and those markets are, running themselves on a managed network. It'd be great to get there someday. There's a big question to the infrastructure cost. That's not, infrastructure finance doesn't pay for that, right? There's different mechanisms pay for that. So I guess your question was, what do I think of it? I don't like it. But it's what it is. Is Tom Steyer in the room? Can you fix that? Over here.
Okay, yeah, Richard Bennett, I got a question, I think, for Chase. So again, I applaud you for what you're doing. I can see the true advantage of this in the market. Is it as applicable to systems? Is there ever going to be a true storage, true solar? That model, I think Tom Lydon talked about it, about the velocity, and he showed the charts of how it was racing rapidly forward. How does the storage component factor into this from a...
So I think the answer is yes. And earlier, you heard Brian Carey with Price Waterhouse talk about the applicability of true solar in other countries. Obviously, what we're doing by way of the risk stack in the U.S. is very unique to the U.S. Risks associated with tax recapture are not applicable in a country like India. But the framework is, and is easily customizable. It's the same thing with storage. It's the same thing with microgrids. Recently, to take my true solar hat off, we began to work with the state of Connecticut to build out a microgrid finance model. The ability to throw a little bit of wind and a little bit of geothermal and a little bit of solar and batteries all together and get a blended yield and understand all those different capacity factors. So, yes, I think it's very applicable. And at the end of the day, we chose the commercial segment because that's where the most friction is. Residential is very replicable. You can rely upon the consumer credit score of the homeowner. Utility, there's just not a lot of deals. The biggest benefit of something like true solar is within the commercial segment. And then the benefit of unlocking that segment is distributed generation. And back to the prior question, if you want to talk about residual value, societal good, anything that allows us to avoid hundreds of billions of dollars of infrastructure upgrades and brings us a safer, more secure grid, I think is remarkably valuable for the nation, and in fact will help ultimately reduce rates. And it's the same thing in storage. As storage becomes more and more commoditized and is married with distributed solar, I think this now becomes the subject of distributed generation versus the utility business model. I don't know if we have enough time to talk about that.
But it's important note. I think wind was the pathway to big centralized renewable, and solar is the pathway to distributed generation. Solar and maybe natural gas, hopefully solar. But ultimately, this tool is going to be needed across all distributed generation, especially distributed renewables, and it's going to be much more complex because the services that those distributed renewables supply are going to go way beyond just kilowatt hours. They're going to provide a lot of different services, and that's just going to create more counterparties, more risk to assess, and the financiers have to get comfortable with that, and the buyers have to get comfortable with that. So I believe this is just the beginning of a much broader industry norm. Couple more questions. One over here. Someone needs to stand up to a jig. I can barely see you.
Hey there. Thanks very much for this panel. Tim Bew from Booz Allen and Hamilton. The way this strikes me is that it seems like the sweet spot for this is about low-risk bankability. And maybe that's a right way to look at it, maybe not. But I'm wondering about looking at the whole hierarchy, the system inside and the policy, regulatory, both of those, to what degree would you see this as taking existing standards in the technology side like IEEE and UL versus influencing those standards to help with the risk analysis for the technical side? And on the regulatory policy side, to what degree do you want to try to influence future regulatory and policy versus just accepting what it is and factoring that into the risk analysis?
Chase, why don't you start, and then we'll open it up to Brian and Evelyn and Conrad to see if they have extra thoughts.
So I think information is power, and so if you've got technical transparency and data and growing data sets on what's going on in the U.S. solar marketplace, you're better informed to inform policymakers. I think we said earlier on that the risk screen is just trying to codify that most universal and best practice around due diligence and not reinvent the wheel. So there are a lot of folks out there that have created technical standards, and we don't want to reinvent that. We want to bring as much of that into our process as we can. And I think you see with our friends with Underwriters Laboratory and DuPont, that's exactly how we're proceeding.
Brian or Evelyn or Conrad, do you have anything to add to that? Oh, Evelyn?
Thank you. So I think that one of the key things to realize about standards is they're living documents. They're not something that are going to be set in stone for a while, because otherwise we wouldn't have a way to support innovation. And so I think that the influence is going to go both ways. As we develop current day requirements for the risk model, as technology changes, as innovation influences better performance, more energy efficient types of products on the marketplace, that's going to reinform how this model grows. And so the risk screen that we see today that gets handed over to the accreditation body in June is not going to be the same model a year from now, nor is it going to be the same model 2 years from now. And I think the purpose of that accreditation model is to help constantly improve and make relevant what's happening with the model as it relates to the equipment. So I think that's why it needs to be a full industry effort, because we can't continually improve that tool unless we have more and more information about more products on the marketplace.
Just a couple of more quick comments. So yes, we are leveraging standards where they exist and where it makes sense to, whether it's a UL standard or an IE standard. We're leveraging SAPSI's standard PPA contract as an existing standard. But there are areas where a standard does not exist, and we're using an input from across the working group to get alignment on those, particularly for roof quality. We may talk to 3 or 4 players in the value chain that have something, that have some sort of interest or expertise in that particular area, and get alignment from those 3 different groups on what a best practice or what a certain level of quality should be for that particular criteria.
And don't forget about OSPARC, who just announced a partnership with Green Tech Media. Encourage all those that have systems out in the field to talk to Tom and company at OSPARC and help them improve the data set that they make available to help us do what we're doing better.
All right. Any last questions? One in the back. There we go.
Yeah, this is Mike Midden from Sol Systems. Thanks, everybody, for the panel today. I had a question about regulatory out clauses in the PPA contract. My question is to anybody, because it's really a True North question. Is True North in the capacity to take a position on regulatory out clauses that we're seeing appear in Indiana and Georgia? And second part of the question, if not, does anybody have any thoughts or ideas how the industry can push back on these regulatory out clauses that we're starting to see emerge in PPA contracts? Thanks.
I mean, I can say real quick that True Solar does address and ask questions about these out clauses. To take a leap from whether it addresses it and asks it and translating that into influencing policymakers to take the clauses out is certainly sharing with policymakers that deals either aren't getting done or are getting priced up because they impose that clause, I think is important. But we don't have an experience having taken that data to policymakers thus far to make that case.
Yeah, look, I mean, I think for lenders especially, but for also, for investors like us, we haven't looked at too many projects in Indiana or Georgia, but just sort of as a general matter, if there are sort of draconian out clauses, it's hard to actually finance those and get value in those projects. Maybe some utilities actually want that's fine, but someone like, I won't speak for Hannon, but I suspect a group like Hannon and certainly a group like RET that offers sort of a long-term sort of coupon or relies on sort of long-term 20-year returns, very stable returns, wouldn't really, it would be a different type of product, different type of capital seeking that out, one that would require much higher returns to sort of price in that risk. And as a result, the cost to the margin to the developer would be very low, and as a result, sometimes not be built.
I mean, I don't have much to add other than educating on folks, a lot of the people in this room, of understanding kind of what is financeable and therefore what allows the industry to grow and what isn't, is helpful. And to take that knowledge and to be a part of the public process, whether it be through formal groups or more informal taking part in the PUC processes, just to provide that input to them, because if they are going down the road, whether large or small, and they're going down the road of renewables, whether large or small, ultimately they don't want to set up something that's not going to succeed for themselves and their ratepayers. So some of these things that may seem small and they might be ill-conceived in a study room, with input from folks in this room and others, can help steer the direction early in the process rather than trying to go back after it's been formed and through a PUC process.
Yeah, I think it's a very difficult question. I would say that from RMI's change model perspective, we believe that money and business speaks louder than anything else. So when the large commercial corporations like Walmart are putting solar on every building, and all of a sudden a state makes it difficult for them, they're going to let that state know. And if Wall Street makes money on this space and they can't invest in that state, they're going to let regulators know and politicians know. So, we're happy to watch people lobby and advocate and do whatever, but we want to create the market that drives the change. So, in a place like Georgia, where, the utilities allow us voice in the room right now, you got to create some other loud voices, which isn't the greatest answer, but.
Well, let me see if I can't put a cap on that. I mean, True Solar is all about understanding risk, so then you can either reduce it, eliminate it, transfer it, or accept it. A regulatory out's not very acceptable. And if it's in the contract, other than negotiating them to revise it, you can't reduce it or eliminate it. So the only remaining question, and I just say this because I was down in the Caribbean recently and I was lamenting that we see a lot of projects in Africa and elsewhere where we feel like some of the risks are just too much for us. And then found it pretty interesting to discover that OPIC will literally wrap the risk of a sovereign later reducing the feed-in tariff, which in some ways is this kind of, this power greater than you coming in and bringing consequence on your project. It might be a good question to ask if Gene Schwartz would wrap regulatory out risk and give you an insurance policy for it, but other than that, it's just a battle state by state.
Any last questions? All right, well, Chase, do you have any final thoughts?
Thank you for doing a great job moderating.
Oh, it's pretty easy when you have great panelists. So I'd just like to thank our earlier panelists, Conrad Burke from DuPont, Evelyn Butler from Underwriters Laboratory, Brian Carey from PwC, and of course up here now, Pat Fox from Hannon Armstrong. I think it said Hannafin Armstrong last time. I was thinking of Hannafin Imhoff. Hannon Armstrong and Tarek Bolat from Renewable Trust Capital. And Chase Weir from
Renewable Energy Trust.
What?
Renewable Energy Trust.
Bad notes.
It's
Renewable
time for
Energy
happy hour.
Trust
It's
Capital.
time for cocktails. No, I do have
All right.
one.
Here's the deal. You got to have one name in your title, or it's not going to work for me.
I do have one last thought. I really encourage everybody to find a working group member and talk to us about how you can get involved.
All right. Thank you, Chase. And thank you, everybody.